Good evening, ladies and gentlemen. You have attracted quite a crowd. Very impressive. I warmly welcome you to the American Academy. Now, I'm Yaara Caspar, and I'm trustee in residence. And my task is not to introduce Mr. von Moltke, but rather that task will be performed by somebody who claims to have been an acquaintance of his father. And so we could hardly resist that opportunity. Now, I have to say, I want to say a couple of things about the lecture, but I have to say something about Mr. Heinz, who will introduce James von Moltke, because he himself is a very remarkable man who has helped quite a few people from the GDR to escape to the West at great personal risk. He talked about this to our fellows the other day, and he left them completely fascinated and captivated by what he had to tell. His book was recently translated into English, just been published, and as part of Show and Tell, you don't have a recent book, no. Otherwise, I would have had that too. But this is the Show and Tell. This is James von Moltke. I'm sorry. This is this is Volker Heinz, called "The Price of Freedom: Courage in the Shadow of the Berlin Wall," and that's all I will say to him about him, because I have little time. Now, I should like to say a few words about the person for whom the lecture is named that James von Moltke will deliver. He is our distinguished Stephen M. Kellen visitor, and this is the Stephen M. Kellen Lecture. Stephen Kellen was for many years the CEO of the investment bank Arnold and S. Bleichroeder in New York. Now, if I had the time, I could entertain you now for quite a few hours about Arnold and Bleichroeder and how they came together originally in Berlin. But I won't do that. I will resist the temptation. Steve Kellen was co-chairman at the time of his death at the age of 89 in 2004. Steve Kellen was born in 1914 as Stephen Max Katzen Ellenbogen. He changed his name later when he was in the United States, because as any American in the audience will understand, Katzen Ellenbogen is not a name that you can fluidly use in English discourse. He grew up in Berlin. He always said about himself, "I became a very good New Yorker, but have always remained a good Berliner." He was a great banker and a great philanthropist, and it's of course fitting that we have a banker deliver the lecture. When in Berlin, Steve Kellen always stayed, I still knew him, Steve always stayed at the Hotel Kempinski, which was built in the same space where his childhood home had been, and destroyed during the war, of course. Steve Kellen's connection to this villa, which belonged to Hans Arnold, as in Arnold and S. Bleichroeder, was profound. Here at a dinner dance in this very building, in this very villa, in 1935, he fell in love with the 16-year-old Anna Maria Arnold, whom he married in 1940 in New York, where both he and the Arnolds had ended up fleeing from the Nazis. As a banker, Kellen had begun his career with the famous Berliner Handelsgesellschaft. In 1940, he was drafted by his father-in-law, rather newly acquired in 1940, Hans Arnold, to help him to re-establish Arnold and S. Bleichroeder. Arnold and S. Bleichroeder had been a bank in Berlin. It was re-established in New York City in 1940 and went out of existence only 3 years ago. Now, I'm sorry, I cannot quite resist the temptation. We have to understand, Bleichroeder, of course, was Bismarck's banker. It is the same Bleichroeder who was Bismarck's banker. And that a bank, and the Arnold Bank, which was originally Dresden Bank, had acquired Bleichroeder in around 1930, 1931. And that a bank carrying the name of Bismarck's banker should exist in New York City until 3 years ago, when it was bought by somebody else, is just amazing, really. The bank did extremely well, and Kellen became an important figure in bridge building between the United States and German business enterprises, and in the arts philanthropy in both New York City and Berlin. It was Richard Holbrooke, the last American ambassador in Bonn, who in 1996 persuaded Steve and Anna Maria Kellen to rebuild Anna Maria's childhood home for the purposes of the American Academy. Of course, that's where we are at this particular moment, in her childhood home and that of her sister. A very dignified man, Steve Kellen thought duty and responsibility were at the core of human activity. Concerned about the world, he thought, sie war aus den Fugen, but also maintained, I'm cautiously optimistic. And I hope tonight we will still be able to be cautiously optimistic of your talk. But now comes Mr. Heinz, who will introduce it.
Good evening, ladies and gentlemen, and welcome to another remarkable American Academy evening. Tonight's speaker is James von Moltke, someone who attracts roughly 200 registered attendees. Must be a very special person. And indeed, that is what he is. As the troubled Deutsche Bank's chief financial officer and member of the management board, since July 2017, he has accepted a gargantuan task. But he is well prepared. Prior to his last appointment, James was the treasurer of Citigroup, where he played a significant role in the company's restructuring following the 2008 global financial crisis. Von Moltke has also worked at Morgan Stanley, where he led the financial technology advisory team, and he spent 10 years at JP Morgan, working in both New York and Hong Kong. Von Moltke is a member of the exchange councils of Eurex and the Frankfurt Stock Exchange, and he serves on the board of directors of the American Chamber of Commerce in Germany and the Center for Financial Studies in Frankfurt. A member of the steering committee on regulatory capital at the Institute of International Finance in Washington, D.C., he represents Deutsche Bank on the executive board of the Deutsche Akteninstitut and serves on the board of directors of Atlantic Brücke. That show's pause gives me an opportunity to thank the person who spoke before me for mentioning me and my little book. That was very kind of you. Now, let's go on. All this, what I just read out, is neatly set out in your invitation leaflet. And as a lawyer without an in-depth training in the world of finance, I do not dare to either add to or comment on this impressive international banking career, with a number of the world's most important, mostly Anglo-Saxon financial institutions. But his outstanding professional credentials are not I presume, the reason why the American Academy has asked me to introduce him to you. Most likely the true reason is that someone became aware that I have met a few members of his wider family and read a lot about them, and others I never met. I will not even try to present a von Moltke family tree, but some of James' relatives who bear his family name are outstanding personalities in Germany's history who really deserve to be mentioned. Let me start with James' father's great-grand-uncle, Field Marshal Helmut Karl Bernhard Graf von Moltke, Bismarck's and the Kaiser's commander-in-chief. After securing Prussia's victories in the 19th century's German-Danish, German-French and German unification wars, he was richly rewarded and bought the Kaiser estate in today's Poland. Kaiser, or now Krzyżowa, if there are any Poles among us, I think I didn't pronounce it properly. Kaiser was eventually inherited by his great-grandnephew Helmut James Graf von Moltke, James' grandfather. Helmut James and his wife Freya were the leading figures in the anti-Nazi resistance movement called the Kreisauer Kreis. When the Gestapo eventually found out, Helmut James was arrested, sentenced to death by the Volksgerichtshof's infamous presiding judge Freisler, and executed in what is now the Berlin Plötzensee Memorial. Like myself, Helmut James, his father, was a Berlin Rechtsanwalt and a barrister at law of the Honorable Society of the Inner Temple. That is an area in London near the River Thames where lawyers do their business. His maternal grandfather was the South African Chief Justice, Sir James Rose Innes, and an Inner Templar as well. And so is Helmut James's son, Helmut Caspar, James' father. If you allow me a small excursion, as I mentioned already, the Temple area in London is where lawyers from the 13th century onwards found refuge and accommodation, initially in inns. That's why these lawyers' associations are called Inns of Court. But there is a strange relationship with Berlin, because the same Knights Templar, the Kreuzritter, the Tempelritter, founded what is today called in Berlin Tempelhof. James' paternal grandmother, Freya Gräfin von Moltke, a widow for more than 65 years, moved after World War II with her two young sons, James' father's Helmut Caspar and uncle Konrad, to the United States. Freya's name is inexorably connected to her foundation, the Freya von Moltke Stiftung für das Neue Kreisau, now an important international meeting point focusing on German-Polish reconciliation. James' father, Helmut Caspar Graf von Moltke, had a lifelong successful career with BASF, one of Germany's chemical giants, representing his company in many branches abroad, inter alia in Australia, where he met and married James' mother, Carrie, an Australian citizen. Helmut Caspar was also one of the trustees of the former Anglo-German foundation Temple Gift, which I established in the year 2000, intended to deepen the German-British reconciliation efforts. Its scholarship program was named after James' grandfather Helmut James, to which Freya personally gave me her permission. But it's now highest time to fully return to our speaker, James, after the excursion into his family. Born in 1969 in Heidelberg, not far from Ludwigshafen, where his father worked with BASF, James grew up as a dual German and Australian citizen in Montreal in Canada. He nods, so I'm right, thank you. Interrupted by a short spell at a German boarding school. He holds a bachelor's degree from Oxford University in philosophy and German. A native English speaker, he is fluent, he modestly says near fluent, in German and pretty good in conversational French. He met his Swedish wife in Australia, and they have 3 young children. Initially I thought they were here, but they are not. I hope I could somehow whet your appetite for James and his talk. I'm sure you will be as impressed by him as I was when I first spoke to him. And we are now curious to hear how he and our politicians can preserve economic dynamism in the face of political, social and monetary pressures. Thank you for your attention.
Well, thank you, Volker, for the kind introduction. Thank you all for being here. Yaara Caspar, thank you for the invitation and the hour that we spent together, which I enjoyed tremendously. I'm very flattered, first of all, honored to be delivering the Stephen M. Kellen Lecture tonight in front of you all, but flattered to have you all in attendance listening to me tonight. I'm much more used to being in the audience, hearing introductions and speakers myself than speaking to you all. Ladies and gentlemen, I'm delighted to be at the Wannsee tonight, and as I say, honored to be delivering this lecture. Some very distinguished people have delivered this lecture in the past, and frankly, I wouldn't compare myself to them, to my eminent predecessors, but I'll do my best to offer a perspective on the world today and provide some thoughts as I see them, perhaps some priorities. As Volker's outlined, my family does have deep roots in Germany. I have an uncle and aunt in the audience. In some ways, I'm performing for them more than all of you, given how long I've known them. As was mentioned, the families of my paternal grandparents were prominent in Germany in the 19th century. On one side, the military family you heard about that helped to unite Germany. In the last century, my grandfather, as we've talked about, and also my grandmother hosted the Kreisau Circle of resistance. My paternal grandmother, Freya, whom you heard about, was the daughter of Karl Theodor Deichmann, a prominent name in 19th century German banking, alongside Warburg, Oppenheim, Bleichroeder, and hence a connection that I have personally to be here this evening. In fact, the connection goes a little bit deeper, and that is that I have a very good friend, Andrew Gundlach, whom I've worked with and been friendly with for over 20 years, who was the original contact and is the grandson of Anna Maria and Stephen Kellen. So, as I say, it's a great pleasure to be here. As Volker mentioned, I was born in Heidelberg and raised in Canada, and my university education was also in the UK. So I feel myself to have grown up very much in the Anglosphere before returning to Germany to take up my current position at Deutsche Bank. I do consider myself an Atlanticist. I returned to Europe only 2 years ago, and so my worldview is very much, I view Germany and Europe very much through the prism of my life prior to coming back outside of Germany. And in a sense, the post-war transatlantic alliance between Europe and the US, which was dynamic, powerful, and rules-based, is very much part of my DNA, and hence, if you like, the perspective that I'll offer tonight. My theme for tonight is preserving economic dynamism in the face of political, social, and monetary pressures. Let me say right up front that if you take away 3 things from my talk tonight, let it be these. First, we're at an inflection point. Post-war certainties are giving way to a realigned, and I think much more competitive, global order. Second, the policy status quo in Europe is not sustainable. As things stand, Europe, and with it Germany, risks falling irretrievably behind the US and China. Third, with decisive and unified action, we can create a set of policies which will help Europe to preserve economic dynamism in the face of these challenges. First, let me describe the inflection point that I believe we've reached. Since the early 1980s, we've witnessed a unique supercycle in the world economy. We've seen unprecedented globalization, trade liberalization, harmonization of rules and standards, and rising prosperity. For the first time in history, global trade accounted for more than 50% of world GDP. The number of people living on less than $2 per day fell from 42% of the world's population in 1980 to around 10% today. Life has been good for Europe and for Germany. Post-war Europe, with its strong transatlantic links, enjoyed a period of peace, stability, and steadily growing prosperity. Germany delivered an economic miracle and sustained its strength even after the financial crisis of 2008-2009. A couple of days from now, we'll celebrate the 30th anniversary of the fall of the Berlin Wall. Many of you will remember the incredible optimism which that brought. An era of Cold War competition between two military superpowers was over. Now this exceptional period may have stalled or even gone into reverse. We're at the beginning of a new era, an era defined by political, social, and monetary pressures, which have arisen mostly in the decade after the financial crisis. Let's look at those pressures. Politically, we're seeing multiple challenges to the status quo right across the world. These challenges take on several forms. Nationalism is reasserting itself. The concept of America First is a good example, but there are echoes in many countries and notable movements in Europe. Populism is on the rise and scoring some remarkable electoral successes. Examples include the Brexit Party, Italy's Five Star Movement, in France, Emmanuel Macron's En Marche movement, which was then itself swiftly followed by the Gilets jaunes. Here in Germany, of course, we've seen the rise of the AfD. Immigration is often at the root of populist trends that we're seeing. Population growth in emerging markets and rising number of economic migrants are fueling nationalist sentiments and populist movements from Europe to the southern border of the US. In addition, a generational shift is challenging traditional politics. For a younger generation, issues such as environment and gender equality are at the center of the political agenda. This generation has grown up in a post-Cold War period, and it's a generation which instinctively harnesses the tremendous power of social media to make its voice heard. The result is a formidable challenge to the political status quo right across the developed world. Boundaries are being redrawn. The traditional right-left spectrum in which centrist parties were predominant is being redefined. All of this is happening against the backdrop of a tectonic shift in geopolitics. The arrival of China as an economic superpower transforms the landscape. Social pressures underlie some of the tectonic shifts we're seeing in conventional post-war politics. In developing economies, globalization brought benefits to many, but in the mature economies, one perceived reality is very dangerous to democracy and the market economy. Globalization and trade liberalization benefited a few, but left large parts of society behind. There's a perception, which I share, that the post-war business, financial, and political elites failed to serve the interests of society as a whole. Deutsche Bank research shows that the benefits of the globalization era since 1980 were not shared equally. Trade boosted income growth in emerging markets. The least wealthy 50% of the world's population benefited. Those in the economic middle, for example, the less well-off in the better-off countries, suffered a squeeze in real incomes. And the world's wealthiest 1% captured a staggering 27% of all income growth in this period. In Germany, even in the more prosperous Western federal states, less than half the population now believe that the social market economy is the best model. In 2000, it was over 70%. In many prosperous Western nations, there's a feeling that inequality has risen. In the US, the ratio of CEO pay to average workers' pay has risen from around 200 to over 300 in the last decade. And this was after it had come down a bit in recent years. In 1980, it was around 30. Turning finally to monetary pressures, we've seen a period of disinflation driven by technological advances and growth in the global labor pool as China reintegrated itself into the world economy. We're in a sustained period of exceptional monetary stimulus. Interest rates are at historic lows and negative in Europe and Japan. conditions we haven't seen since central bank records began. That has important implications for Europe, none of them good, in my opinion. Firstly, parliaments don't see the need to carry through much needed but politically unpopular reforms. That places the onus on central bankers. Economies and markets are driven not by fundamentals, but by central bank policy. We risk entering, or have already entered, a vicious circle of negative interest rates, slack demand, and an absence of growth stimuli at a time when debt levels of leading nations at around 70% of GDP are higher than at any peacetime in the last 150 years. $17 trillion of debt, that's around 20% of global GDP, currently produces negative returns. As a result, asset bubbles may be forming in equities and real estate. The wealth transfer away from creditors on such a scale risks perpetuating poor economic performance. That adds to the political and social pressures I just described. In addition, retirement planning is more difficult than ever. Pension funds and insurance companies have to take greater risks to produce the income streams their liabilities require. With asset bubbles and negligible returns on savings, social inequality may actually increase. In recent months, there has been discussions about the impact of negative interest rates on the banking industry. The impact is significant. Just one example lies in the difference in interest rates between the US and Europe, equivalent to a revenue head start for US banks over their European peers of more than 40 billion euros per year, just on their respective reserve balances with their central banks. However, let's be clear, the impact of negative rates on the real economy is much more important. These are the pressures we face. Let me now turn to the competitive dynamics. The world powers of today are competing with each other on multiple dimensions: economic growth, geopolitical influence, military capability, cultural and social dimensions, and last but not least, technological development. A couple of observations about these. First, economic growth is the cornerstone. Without it, competing on other dimensions is not sustainable, which is why preserving economic dynamism is all important. This was decisive, for example, in ending the Cold War. For all its military capability, the Soviet Union could not stay in the race against the dynamic post-war US and European economies. Second, we're in a phase where investment in technology infrastructure is a key enabler. Artificial intelligence, the development of e-platforms, digitization, and harnessing of data are all part of what the World Economic Forum likes to call a fourth industrial revolution. The rewards of capturing first mover advantage have never been higher. DB Research, corroborated by analysis from McKinsey, has calculated the innovation dividend at between $15 and $20 trillion. That's close to the total annual economic output of the United States. In other words, preserving economic dynamism is going to be much harder if we fall behind in technology investment and fail to reap our share of the innovation dividend. So now let me come to my second takeaway. Why is the status quo not sustainable? To answer that, let's look at what the inflection point means for Europe and for Germany. First, the world will become much more competitive. Some of us grew up in an era of competition between the US and Russia, mostly on two dimensions: military power and geopolitical influence. Now we see the US and China competing on multiple dimensions. Second, the relationship of these global economic superpowers with each other will cause a realignment of their relationships with Europe and other parts of the world. Third, and particularly important for Europe's export champion, Germany, the traditional legal and institutional frameworks of international trade are being challenged. The competitive game will be played out not only in our export markets, but also in our European backyard. Finally, the scale of investment in technological transformation and the size of the returns on that investment will be key to preserving economic dynamism relative to competing nations. That will determine winners and losers in the new era. The key question is, how do we stack up? Are we well placed to compete with the US and China in the global race we're in? Our start point is not encouraging. Since the economic crisis, we've been in a three-speed world, with Europe in the slow lane. Euro area growth is just over 1% so far this year, and slowed in the second quarter, outpaced by annual growth of 2 to 3% in the US and around 6% in China, even though there are doubts behind the growth rate in China. So what are our strengths and weaknesses? Europe has clear strengths. The mechanisms of social cohesion are strong, stronger than in either the US or China. Social safety nets are robust. In Germany, after the financial crisis, we avoided a spike in unemployment through strong cooperation between the government, the business sector, and labor unions. Public education is generally of a very high standard. Physical infrastructure is good, notably our transportation network, a key enabler of an effective single market in goods. And cultural institutions and cultural life are rich and varied. But Europe also has significant weaknesses. The pace of economic growth and growth prospects in Europe have been distinctly lower than either the US or China, indeed slower than most Asian economies. No less worrying, we are well behind the US and Asian, notably Chinese tech companies, in the race for first mover advantage, and therefore the race to reap the benefits of the fourth industrial revolution. In addition, the monetary pressures, which we've just discussed, affect Europe more than the US. With interest rates still in positive territory, the Fed still has room for maneuver. In Europe, rates are already negative. Policymakers have fewer options remaining. That's why the status quo is not sustainable. We require an active catalyst to restore Europe's economic dynamism relative to our geopolitical competitors. So let me now come to my third and final takeaway, creating a set of policies which can restore Europe's dynamism. First, let's ask, what are the essential preconditions for preserving economic dynamism? I believe that 6 factors are decisive. First, educational excellence. World-class universities can have a huge economic impact. What's important is not just how excellent they are, but also how they contribute to the business communities around them. Second, a strong financial system. This has many dimensions: the strength of individual institutions, regulatory and supervisory regimes, central bank policy, and deep, efficient capital markets. Third, effective regulation. Regulation that governs and oversees, but does not stifle economic dynamism. No less important, we need to avoid unintended consequences. For example, that financial regulation restricts the banking sector's ability to finance growth and investment. Fourth, a supportive tax environment. This means more than efficient collection mechanisms. It means tax rates and policies that support business, encourage investment, reward entrepreneurial wealth creation, and do not penalize risk-taking. Fifth, high-quality infrastructure. This includes not only traditional physical infrastructure, but also, more important than ever, technology infrastructure. Finally, responsive political institutions, capable of acting with agility, decisiveness, and unity. That's key in a rapidly changing and more nationalistic, competitive environment as the geopolitical order realigns itself. I'm convinced that in every essential area, we have the opportunity to formulate policies which will enable Europe and Germany to compete. We must base these policies on a realistic view of where we start from. If we look at our scorecard today, a number of priorities become clear. First, turning to educational excellence. Europe has solid standards in school and university education. Germany has some excellent universities, and, for example, the unique network of Max Planck institutes. Additionally, Germany's strong tradition of vocational training and apprenticeships makes a significant contribution to our highly skilled workforce. However, it's not just the quality, but the economic impact of our educational institutions that matters. Let's benchmark ourselves against global competitors. It's been calculated that Stanford University, which has around 7,000 undergraduates, has an annual economic impact of roughly $3 trillion, mainly through the 39,000 businesses founded or run by alumni, comparable to the annual economic output of the UK or France. Oxford and Cambridge started later than their US counterparts. However, Oxford and Cambridge have helped flourish or build flourishing new hubs to develop around their campuses, for instance, the Cambridge Science Park. Cross-regional comparisons are difficult, but in a 2018 study, the League of European Research Universities estimated that the gross value added of this group, that league, contributed some 400 billion euros across Europe through spin-outs, licenses, and services to businesses. Europe has outstanding academic institutions. Our priority must be to increase their economic impact by forging closer links to the business sector, especially communities of entrepreneurial innovation, for example, by sponsoring research. We see encouraging developments both at European and national levels. The European Universities Initiative, formed this year, is a flagship project to create and fund pan-European alliances as part of a wider aim to create a European education area by 2025. Germany's Exzellenzinitiative, which has identified 11 universities and 57 clusters of excellence across Germany for additional funding, with over 500 million euros per year available from state and federal coffers. We can also point to specific instances, for example, in Munich, Frankfurt, or here in Berlin, where universities are building links to local communities of innovation. This is also vital in preventing a brain drain of Europe's creative talents to work in innovation hubs outside of Europe, where there are possibilities that are greater and financial rewards are also greater. Around 50,000 German nationals already live and work in Silicon Valley, among them the brightest people we have. We invested in their education. The US economy reaps the returns. Now let me turn to the second key factor, a strong financial system. Europe's financial system has been strengthened considerably since the financial crisis of 2008-2009. Oversight is far tighter, and leading institutions have strengthened their balance sheets. I will take one issue, Volker, with your comments about the troubled Deutsche Bank. We can talk about that later on. But I spent part of the afternoon with some journalists in town explaining our balance sheet and some aspects of our business, which I'd be delighted to go through with you all. But we lag behind on the banking union and capital markets union. This has repercussions for competitiveness, both for banks and European businesses. Europe's fragmented capital markets do not have the scale or depth of the US market. This places Europe's businesses at a significant disadvantage in financing growth. Roughly 70% of financing for US businesses is through the capital markets, compared with around 30% for European companies, who still rely predominantly on traditional balance sheet lending. Brexit will make matters worse if it limits access for European businesses to the City of London, Europe's only world-leading global financial center. Europe's banking industry is still fragmented. Consolidation is behind that of the US, and cross-border consolidation has proved difficult. We face a lack of harmonization of regimes, plus linguistic and cultural barriers. Europe's leading banks are at a scale disadvantage to larger peers, both from the US and from China. That's important when 9 of the world's top 10 banks, as measured by market value, are either American or Chinese. Regulatory harmonization has further to go. For example, product rules and bankruptcy codes across European jurisdictions. Many of our financial institutions lack the global reach needed to help diversify European investments globally. That partly explains the long-term erosion of an important source of wealth in Germany, a competitive return on overseas investments. Over the past 40 years, Germany's overseas investments have returned about 5% annually, half the rate of the US or UK overseas investments. Over that period, the cumulative gap in returns adds up to a staggering 3 trillion euros, according to research by the Kiel Institute and the universities of Bonn and Munich. That's bigger than Germany's national debt. In this new era, that's a competitive gap in wealth creation we simply cannot afford. Global financial institutions plus deeper capital markets are both vital in helping diversify and enhance returns on investment. A more developed equity culture among Germany's famously conservative, cash-oriented savers will help both investors seeking returns on investments and businesses seeking capital. Europe's financial industry can play a vital enabling role for Europe's economy. We can turn savings into capital through either credit or capital markets access, provide liquidity for Europe's financial system to run effectively, and help boost returns on overseas investments. Regulation that enables rather than constrains banks as an economic enabler are vital. And that brings me to our third factor, regulation. Sound regulation is essential for a global rules-based economy. However, we run the risk that regulation brings unintended consequences. We need to ensure regulation doesn't act against the economic dynamism we must urgently preserve. A few examples. A number of game-changing US technology companies have faced regulatory hurdles in Europe. We need to re-examine our approach to data. The US and China have built a commanding position in data gathering and availability. This has led to a host of technological advances. Europe's focus has been on regulation around data privacy. Going forward, we need to strike the right balance between data privacy and data as the essential building block for technological development. In banking, we've seen intensive re-regulation in the decade since the financial crisis, quite understandably. However, in the current environment, banks in Europe find themselves caught between monetary policy on the one hand and prudential supervision on the other. We run the risk of contradictory outcomes. Monetary policy aims to stimulate the economy by spurring lending and encouraging investment. But prudential regulation, in the shape of Basel IV and many other elements, risks choking off the supply of credit to the economy by making lending more capital intensive for banks and more expensive for Europe's businesses. While at the same time, negative interest rates prevent banks from building up capital from earnings on deposit margins, capital which could be deployed to support more lending. And of course, this will hurt European companies more than their US peers, because European companies are more dependent on traditional bank lending to finance their activity. I recently read an argument that Europe's future lies as a regulatory superpower. I think that's an oxymoron. In the harshly competitive environment we face, superpower status depends on capturing our share of the innovation dividend, which arises from first mover advantage in transformative technology. We must avoid a scenario where the US and China are busy innovating and Europe is busy regulating against innovators, from whether that's competition from outside Europe or, importantly, our own innovators. Surely our goal must be to regulate as little as possible beyond what is necessary to protect individual citizens and society. Let me now turn to my fourth factor, the tax environment. We need to make progress in several areas, both in Germany and in Europe. First, we need to look at the absolute level of corporate taxes. Germany is now at the high end of corporate tax rates, while the US, for example, decisively cut taxes. Germany remains some 8 percentage points above the OECD average. Second, tax systems need to be less complex and more agile. Germany's multi-layered system, with federal track taxes, trade taxes, and a solidarity surcharge, is a case in point. To give another practical example, Germany still levies a 6% interest on delayed tax payment and pays it on refunds. In today's negative interest rate environment, that's punitive. It's particularly challenging for small businesses or new companies. Third, across Europe, we must leverage our tax systems more systematically to incentivize innovation and new business creation. In practical terms, this means tax incentives such as credit for research and development, and a beneficial tax regime around intangibles created through innovation. Finally, and perhaps most important, Europe needs to form a more unified front. Across member states, we still see too much fragmentation. EU rules are applied differently and at different speeds across member states. Within Europe, we still have a tendency to look inward and compete against each other. Instead, we need to look outward at Europe's competitiveness versus other nations. A race to the bottom, where we compete to attract investment against our EU partners, enables competitors to exploit inconsistencies between European jurisdictions. Turning to high-quality infrastructure, Europe's main economies spend a little over 2% of economic output on infrastructure, comparable with the US, but well behind China's expenditure, which is over 8%. Part of the difference can be explained by catch-up in a rapidly growing and urbanizing economy, but China is also investing significantly in technological infrastructure. On physical infrastructure, Europe stacks up well. I know it's common to grumble about the state of infrastructure in one's home country. I relocated to Europe after spending 18 of the last 22 years on the North American continent. Europe's transportation networks and other infrastructure strike me as very good. However, technology infrastructure is key in the competitive world we face today. Given the enormous benefits from technological first mover advantage, that includes AI, e-platforms, e-mobility, and the transition to 5G. The investment needs are considerable. For example, rolling out networks of charge points for electric vehicles or 5G towers. Investment on this scale requires cooperation across the public and private sectors and committed leadership by policymakers in Europe. In the view of Deutsche Bank economists, this investment could and should be deficit funded. And this illustrates why, in terms of financing transformational investment, the private sector needs access to deep pools of capital. The Capital Markets Union is essential for that. Finally, we need responsive political institutions. Post-war Europe has evolved robust democratic institutions, and the administrative apparatus of the EU has expanded significantly. However, we're challenged on several fronts. Post-Brexit Europe has an opportunity to ask some fundamental questions about our future direction. For example, are we unified enough? Can we define sufficient common ground across European states to craft a clear, coordinated response to the competitive pressures we face? On too many fronts, capital markets, banking regulation, and taxation, we're still fragmented or competing against each other. We cannot afford that. While the US and China show single-mindedness and unity of purpose in pursuit of their interests. Are we representative enough? After the challenges we've seen to Europe's established political order, can we create the coalitions capable of driving real change? Paradoxically, bold approaches may prove more electorally appealing than incrementalism. Fortune may favor the brave. Ladies and gentlemen, let me conclude. We're at an inflection point. A realigned and much more competitive world order is emerging against a backdrop of technology transformation. Responding is not optional, it's imperative. Under the status quo, we will almost certainly fall farther behind economically. That impacts Europe and Germany, and our ability to project and defend our values around the world. Economic dynamism is a bedrock requirement for other issues at the top of the public agenda, such as increasing social justice, reducing inequality, and combating climate change. Without a dynamic economy, we cannot properly address these issues. Our response must be several things. It must be bold, decisive, comprehensive, and above all, unified. Fragmentation is already a barrier to Europe's competitiveness on many levels. But if we work together across European states and across constituencies, politics, business, and finance, we can formulate policies to preserve and rebuild our economic dynamism. And that will define our place in a realigning world. Thank you. So now the fun part.
Now, yes, I should say that James von Moltke said while we met earlier that he looks forward to the question and answer period. He thinks that is the fun part, though your lecture was a very considerable part. So I will entertain questions. Yes, that's wonderful back there. Yeah, you're...
Hello, my name is Jason Kirkpatrick, and I have a question. I was very interested in what you said about the fourth industrial revolution and new innovative technologies. And then related to climate change, it seems to me there's a lot of opportunity for growth. We've read in the last year that BlackRock Investment Group lost $80 billion last year because of investments in fossil fuels. In Berlin, the city-state decided to go fossil fuel-free with its pension fund, and they switched 700 million euros. They made it fossil fuel-free, and in the last 3 years, the alternative index fund that they've built has done better for the Berlin pensions than the old fund that had fossil fuels. So I understand the European Investment Bank is not going to be investing in new fossil fuel infrastructure. Now the federal government is looking at this fossil-free investments. Do you think that this is an opportunity for dynamic entrepreneurialism as well to invest in new technologies, solar, wind, what have you? Is that an opportunity for growth and solving the climate problem at the same time?
Mm-hmm. Look, I'm a believer that ESG, incidentally, I had dinner a couple of weeks ago with someone who runs a large asset management complex, and he interestingly said they've now built ESG across their fund complex. So whereas most organizations will say we've got some investment products and then we've got ESG products alongside them, they've got it across their platform. And he's saying that it's helped them in some ways in terms of their performance, avoid problems that have cropped up with companies that are outside the ESG indices and what have you that they play. So I'm a believer that it can channel capital and do so without necessarily disadvantaging investors. Although I did read separately about a week ago that a comparison had the total returns from ESG funds being about 1.2% below returns from the market generally. So there are two sides of that equation. Look, as to whether investment in green technologies can be a good investment, both socially and financially, I absolutely believe that can be the case. But I also believe that a lot of money will go in fruitlessly into those investments. So it wouldn't necessarily be investment advice, because one will have to be careful about investing in the successful technologies, competitive technologies. And the performance of the less favored sectors at various times may be in fact better than the favored sectors, depending on, for example, the price of oil. So I think it's a mixed picture. There's certainly an opportunity, and if we one day find what is truly a breakthrough technology, that could be obviously game-changing for the world as well as for investors. But so I think it's a complicated field. Yeah.
Thank you for this interesting lecture. Manfred Nitsch, I'm an economics professor here at Freie Universität. And of course, many of us are here also to hear a little bit about Deutsche Bank, which has such an image of bad banking at its worst. The fines are finally the result of really bad crimes, and nobody really is taken to court until now, except some of the Ackermanns. Which say Zeugnisverweigerungsrecht, we don't say anything. So what is your turn now to turn the Deutsche Bank perhaps into one of these institutions again in the international sphere. 2 years is not a long time, and you said you were willing to talk about it. So, as an economics professor, having been following that for 50 years now, I'm quite interested in what you have to say.
Sure. Look, the banking sector, and Deutsche Bank, has played its role in this, and therefore paid its price in terms of legal settlements, fines, and profit disgorgement, and what have you. The banking sector discovered post-crisis that there were a number of practices, conduct problems, and other issues lurking within it, and so the financial crisis was, I think, uncompromising in displaying what those were. And frankly, and this is something that we live with and is a real challenge for the sector as a whole, the social relationship between the banks and taxpayers, society, was badly damaged after the financial crisis. And so much of the last decade, frankly, has been spent cleaning up those problems, and hopefully over time reestablishing our relationship with society. Now, if I speak personally, speak for Deutsche Bank, we have worked hard over the last several years to put a large number of issues behind the institution. And when I say behind the institution, let's take two ways in which that's the case. One is, of course, we dealt with a massive wave of what we call litigation and regulatory enforcement matters. And so if I look back, say, to our accounts in 2016, we had a total balance of reserves for litigation of 7.6 billion. And we've now paid out significant settlements and fines from that number. Of the matters that existed back in 2016, we had what we thought were the 20 highest risk matters at the time. We've settled or completely sort of removed 19 of the 20. So we're nearly through what was a very difficult wave of conduct and other issues and settlements that we faced. The other way we've addressed it is a significant investment in controls. We now spend about €1 billion a year on a series of control functions and capabilities, whether audit, compliance, KYC, anti-financial crime, of course our risk organization, and other elements of how we run our company. And that occupies about 5.7 or 5,700 people in our company every day. So I want to demonstrate with that the commitment to not repeat some of the mistakes that were discovered and in the post-crisis period is very strong. Now, of course, to some degree, that commitment arises because regulation has forced us down that path, but it also exists because the management has learned from the mistakes of the past and does not want to repeat those mistakes. It's our responsibility to keep the company safe from these kinds of conduct and other issues. Which isn't to say that we're a perfect institution today. We still have work to do. But it's to say that the culture has changed and is changing in the industry as a whole, including in our company, recognizing that some of the practices that were discovered post-crisis absolutely couldn't repeat, couldn't continue. Now, one of the things that I would ask you to look at is as you read the papers every day, which I can tell you as a board director of Deutsche Bank is a difficult thing to do, because we are truly in the papers every single day. But those events are all pre-2015, and many of them predate the financial crisis. And again, that's not to tell you that we're a perfect institution today. We're on a path that I think is a path of improvement. But to tell you that many of the problems you read about in the press today take a very, very long time to be fully resolved. And hence, you can get an impression from the press, from reading the press, that it's a company and an industry that really hasn't, found a way to redemption. And speaking for the 90,000 employees of Deutsche Bank, we obviously feel that we are on the right path and we want to stay that way.
Yes, Laura?
Hi, I'm Laura Tyson. I'm one of the wonderful, gifted by the Academy fellows here. So I want to thank the Academy and also thank you for it was a wonderful speech. I really learned a lot. You covered, I can't think of anything you haven't covered. It was great. A question about one of your 6 areas, and that is regulation. Because one of the things I think I'm picking up in the U.S. is this desire to learn from the Europeans. So on privacy, we now have a new privacy law in California, which is even more demanding than the GDPR. And a number of other states are following. Anti-competitive practices. A number of people are looking at what is happening in Europe and saying, the Europeans are going after the anti-competitive practices and monopoly power of these very large institutions, and we're not, and we can learn. And then the last thing would be sort of the issue of stateless income, that a lot of these large entities basically have moved their production and their sales around the world in such a way as to essentially deprive the public sector all around the world of revenue. They have they're stateless in terms of revenue. And again, I think the Europeans seem to be moving forward in that. So I want to give a little credit to the Europeans in terms of leading the way as we try to think about it. And I wanted to get your sense of that, because I certainly picked that up in the U.S. conversations among economists.
Boy, they're all interesting topics, Professor Tyson. This is what the risk you run if you're sort of, speaking to a very august audience. Let me actually take it in reverse order. So, stateless income is an interesting one. As you know, there's a lot of work going on in the taxation world around base erosion and profit shifting, known as BEPS. And it's a fascinating sort of topic. I do think there's an enormous amount of work that needs to go into BEPS reporting over the years to come. We're actually doing something I'm helping to lead inside Deutsche Bank, which is the costing of activities inside the bank. How do we, for example, licensing, in which entity, in which jurisdiction do we create intellectual property like software? And then how do we charge other entities within the group for the use of that software is a good example of what you're talking about. Now, the way you solve it is actually in something pretty simple, which is documentation. So we have to substantiate that the software was developed in Singapore. And we have to do that not for the Singapore authorities, we have to do that for the German authorities, who will say, we want some of that income. And in many respects, we then have to do what is called APS, advanced taxation agreements that we enter into then with multiple taxation authorities around the world to essentially agree how that should be shared. So over time, what I think you'll see is the creation of pretty elaborate documentation regimes to deal with base erosion and profit shifting. And while it's always going to be a fight between taxation authorities, I think there are, you can answer those questions reasonably tangibly. At least I think so. And it's true, I think, for our industry. But it's an interesting topic. On privacy, my comments were a little bit less generous to the European privacy environment than frankly I intend to be, because I agree with you. The Europeans are onto something on this privacy issue. I think GDPR probably was too heavy-handed. Are there media representatives in the room, by the way? I asked, we have a comms person from Deutsche Bank in the room to make sure I don't go too far off-piste. But I think GDPR was a little bit too heavy-handed in some ways. First of all, the fine regime is punitive and potentially, nullifying. So that's a problem. But the concept of, some of these privacy ideas is a good one, and I think society hasn't yet remotely started to deal with some of these problems. And so you're right, in the same way that the United States and China are hugely advantaged by the more permissive privacy regimes they have in terms of creating data and then figuring out how to use it. Equally, they may find that the Pandora's box is much wider, more open more widely than here. I don't know that that's right now a great trade-off, because it's hard to say where it will really end up. I mean, if you end up with 15 trillion less well off, but with citizens with protected data rights, you might regret that choice. But you might regret the alternative, and I can't really say how I'd come out on that as a final analysis. Antitrust is interesting. You know, we had this discussion on our supervisory board the other day. And by the way, in the US, antitrust law tends to be interestingly partisan, although I never understood quite why that is. It's a strange feature of US that antitrust law plays the way it does in a partisan way. I think the signal decision by the Europeans about the Siemens-Alstom merger, for a lot of people in private industry, that is an example of antitrust law having gone too far here. And that the reason for it is, there's an argument to be made that we've sort of killed the prospect of a European national champion in that kind of mobility or transportation. And part of the problem was the definition of the market, which sees a national champion as being in the old borders, and is inconsistent then with the idea that Europe should be defined, more broadly. And hence, I think a lot of people would say that decision is an example of too technical a reading of antitrust law. And so I hate to say it, I tend to be on the sort of permissive side of the spectrum in antitrust. And I think particularly in Europe, where we have to worry about our competitiveness, as I said in my remarks. Go ahead.
One thing is it's not just about antitrust. What you just said, I completely agree with. A number of things interpreted in the U.S. from watching Europe is, okay, you're not going to really go after the traditional antitrust. You're just going to go after fining the anti-competitive behavior of the big companies.
Yeah.
Just fine them. I mean, you can't deconstruct them, so you fine them instead. So that might be another way to think about it.
Yeah. And look, I mean, I think there's an interesting question about whether Europe uses the antitrust laws as ways to either damage or restrict foreign competitors, and in many instances, and it's hard to see. And frankly, fines. There's an interesting question as to how fines affect corporate behavior, and so these are all three of them are very interesting topics. Please.
I would like to raise a point which you made, and would like to ask you, what do you expect from Madame Lagarde as president of the ECB?
Well,
how do you regard her currency policy, her exchange rate policy, and her price stability policy? I think that's very elementary and crucial for us to know. Thank you.
Sure. Well, don't get me started on monetary policy. As you can imagine, I have strong views about monetary policy and the wisdom of where we've gotten to. And I can't really speak for Madame Lagarde. I don't know her, and she's not yet in her office. Although her public commentary has suggested she'd support, the current set of policies at the ECB, and I think that's natural when you're coming in and inheriting essentially a policy situation. In fairness, a lot of people in the banking industry, because of her particular background, are a little bit optimistic about her seeing perhaps a different balance than Mario Draghi did, and the view that her views may be less influenced by, call it, academic economists and more tied to the sort of real economy and the impact on the banking sector. Now, that may be sort of hope or an optimism being eternal and we die in despair. But I think she's got a really difficult set of problems to deal with. Because, if you ask my view, I do think Europe has a risk now, and I alluded to this in my comments, that we cannot escape the drag of negative interest rates and what people in the US were calling escape velocity, and the Fed achieved that. And it was a remarkable achievement that the Fed did starting in 2015. In some ways, by the way, created by the taper tantrum. I think the taper tantrum that happened in 2015 was the best thing that could have happened to the world economy, oddly enough, because it taught the Fed how important it was going to be to communicate monetary policy changes very, very carefully and over a long period of time. And that's what they did, and they got to much higher interest rates and created that room, and Europe missed that opportunity. So Madame Lagarde has a very difficult challenge ahead of her. I think our perspective and that of our economists is that this reversal rate that people talk about has been reached in Europe. And it's just simply not the case that another 10 basis points will change, the behavior of borrowers and maybe not even savers. I mean, we were talking about this earlier. The deposit is arguably the best investment product in Europe today, because it's zero, which is 60 basis points better than a 10-year government bond in Germany. It's daily liquidity, and its credit is our credit or that of a savings bank or another institution. There's this irony that they've made, while they're trying to get deposits off the sidelines and to be invested in productive activities, they've actually made the deposit the best investment in Europe, and that's very painful for the banking sector.
Anybody in the back of the room? No? Yes, ma'am.
Good evening, ladies and gentlemen. It's an honor to be here tonight about digitalization. I would like to know if online banking gonna replace the classic form of banks. Thank you.
For most transactions, it absolutely will and has. One of the reporters I was with today asked, why do you have branches at all? And the answer is they play an important function in often new account acquisition, in face-to-face advice on things like mortgages, investment products, pensions, and what have you, and for clientele that are older and less inclined to engage with a bank, on digital form. But over time, all three of those reasons become less and less as more accounts are opened digitally, as more advice is actually delivered in remote fashion, and frankly, as the population ages and people that grow up that are much more used to dealing with electronic media. So the banking industry is in that sort of evolution to becoming much more digital, and I don't think it ever goes fully digital because of a number of things, but one is you want to feel and touch your bank. You want to have some human interaction, and so it's an important part of banking. It's part of the intellectual property, as I think about it, of banks, is the relationship that we have with our customers and the trust that they have in the people who are advising them, and that you can't replicate on your mobile app.
That kind of makes it easy for me to ask the question I asked you earlier when we met privately, but I think it might be interesting for the audience. Why did you not merge with
Commerzbank?
Commerzbank?
Yeah, thank you. So, and I'll give you the same answer. The short answer is that the numbers didn't work for that merger. Normally, you'd think that in-market mergers of banks, I was a bank M&A person for about 17 years, and so worked on a lot of mergers of banks, and almost always in-market mergers work financially. Because typically you don't give up too much in the way of the revenues of the combined entities. You take out a lot of expense on a pretty similar capital base, and the combined company is just more profitable. We couldn't make that work in the Commerzbank situation, which actually tells you a lot about the environment we're in. First of all, on the revenue side, it's interesting. If you ask a lot of people, they tell you that they're either at Deutsche Bank or Commerzbank, and they made a conscious decision to be one or other of the banks. They don't want to be with Deutsche Bank if they're at Commerzbank or the other way around. And their other banking relationship is typically with a savings bank. And after a merger, that would not have changed. They would have had one account with the combined Deutsche Bank, Commerzbank, and the other account with their savings bank. So the dyssynergies are actually larger than you'd see in most countries. The expense synergies were costly, and would take a long time to achieve compared to, say, a U.S. merger or a U.K. merger. And then there wasn't a benefit from a capital perspective. In fact, there was an argument that we would have required more capital to affect the transaction. So the math didn't work. And that was before you get to what are some very, very difficult stakeholder issues. We would have been letting go something between 25 and 35,000 employees in Germany, which would have been very, very hard to do, and closing a lot of branches and doing something that would be damaging to a lot of people and clients and our stakeholders. So that's something you only do if you feel very, very confident that the financial rewards are worth having. And finally, that you could do it with a degree of execution risk that is acceptable. And our judgment was that if you add those things up, including the execution risk, it just didn't work. You had a follow-on question there, too.
Thank you very much for everything you explained up to now. Could I ask you to give us your view on the prospect of economic development of Britain after it left the European Union? I mean, it might not be such a bad idea after all.
I agree. I'm generally in the camp of those who are relatively sanguine and so optimistic about the UK's prospects outside of the EU. I think it depends on what they do with it. Whether it's tax policy, trade policy, other things that they do in the UK after Brexit. But I think there's every reason to believe they can thrive. Of course, the trade relationship with Europe is hugely important, and so not an inconsiderable issue to be dealt with. Frankly, my own view is that Europe doesn't have in my judgment, I don't think there's a strong argument for a punitive transition or exit relationship. Europe has a significant interest in a successful Great Britain economy. And so I think that is often in the public discourse is underweighted in Europe. It's very interesting. I live and work between London and Frankfurt, and so I see the dialogue on both sides of the channel, and I think Europe underestimates the economic impact of Europe of an exit and the damage it would do to the UK economy. But that's one person's view. I could be wrong, and it could be devastating. So we'll see what the result is.
There's somebody way back there. Yes.
We'll come to you. We don't want to be frontist, as the people say.
Dietrich von Kiau, former economic minister in Washington. So I know a little bit about what you are talking about, but only a little bit. And I've been very much impressed, and I thank you. It's very impressive. But your last remark about the United Kingdom and how we should be careful. Yes, we should be. And we should also try to reduce and keep within limits the damage which we all will have to live with. But there are other developments inside the Union which will reduce the negative consequences. For instance, at this very moment, Poland has overtaken Britain as our most or more valuable trading partner. Things inside the European Union are changing. We are no longer simply depending on a close relationship only, let's say, with Britain and France. We also have, as a consequence of Eastern enlargement, the German hinterland, which is Eastern Europe. Mm-hmm. And I have another figure for you. If you take Visegrad, the 4 countries, if you take them together, Poland, Hungary, Czech Republic, and Slovakia, they are, for us, Germany, more important as trading partner now than China, than the United States, in volume. I'm not talking necessarily about quality as far as the United States is concerned. Yep. But certainly, with regard to Russia, things are changing, and we have a different situation than when you studied in the United Kingdom.
Yeah, it's interesting, and this has been Germany's situation, and since before Bismarck, right, is Germany fundamentally a Western-facing country or an Eastern-facing country? I'm of the view that economically our interests are served if we're Western-facing, and I understand that there is a circle around us of economic interests and economic opportunities that I understand and agree with, but I do think that the dynamism that I was focused on in my comments, that dynamism comes from the relationship between Germany and countries to the west of us, much more so than to the east of us, with the exception, frankly, as you point out, of Poland. Poland has been a remarkable country in the years, and by the way, very special for all of us who've had some involvement as a family in Poland in the post-Wende period. So I'm in agreement with your comments about the dynamism of Poland is fundamentally healthy for Germany and the German economy. Let me actually maybe talk about it not west and east, but what I think of as this Anglosphere. I really do think that the dynamism in today's world and our interests are served by being closely aligned with this Anglosphere. And that's where I see the economic dynamism much more than some of these other places. And perhaps that's a belief born of how I grew up in my career experiences, which are very Anglo-Saxon in their nature, but it has imbued me with that feeling. Please, you were overlooked beforehand.
Hi, I'm Suki Kim. I'm a fellow here at the Academy. I'm a fellow at the Academy, and I'm a writer. So you talked about before in answer to your question about the bad ethics of Deutsche Bank, and you said that there's a commitment to not repeat the past and also a conduct problem. So what about the whole Trump question? Because I think somehow it hasn't come up tonight, and it is American Academy, and with the whole tax returns, and I know there's a Deutsche Bank, I guess a lawyer or someone sitting here, and so commitment to not repeat, and the endless loans. I mean, what's the new? One of those mistakes. So I'm just, not to put you on the spot, but I'm just curious what your position is to not repeat the commitment.
So look, we can't and don't talk about individual client relationships. One can hide behind that, and it's appropriate, not to talk about individual client relationships. I guess what I'd point out is, and we'll see, by the way, there's lots of noise that comes out around congressional, committees and all these things. But it's not illegal to have a client relationship with someone who becomes a president of the United States, and someone who's then controversial in that role. That is not illegal, and so, I think. We'll see what there are lots of things that are thrown at the company in this regard. Ultimately, we can only go through the committee process and have them find out what they find out. But the fundamental thing of serving an individual is nothing that one has to be ashamed about.
In conclusion, I will ask you the Steve Carell question. Are you cautiously optimistic?
I am. As much as I've been living, more than most people, I've been living in the post-crisis period now for over a decade, because so much of the last 10 or 11 years of my life has been working to fix companies that were damaged by the financial crisis, by what happened to the assets we held, but also the conduct issues and what have you that arose. So I'm very much still living sort of in 2009, which I can tell you is no fun. Cleaning these things up fundamentally is a big job. I think Deutsche Bank is on the right path. I obviously represent the company and its management in the decisions that we've made, but I think equally. I represented the same thing at Citigroup, which made enormous sort of strides in this last decade. And while I do see a lot of challenges, you know, my nature is to be optimistic in the whole, and so I am cautiously optimistic by some of the things that I see around me, and hopefully we'll see some of the fruits of good decisions in time.
Thank you for a wonderful